All right, welcome to your day one briefing. You're the new Chief Operating Decision Maker, the CODM, and that means your perspective is now the company's perspective. So this guide is all about making sure the way you see the business on the inside is exactly how the world sees it on the outside. Let's dive right in.
So let's start with a really basic question, but it's a huge one. How do you truly see your business? I'm not talking about that one big consolidated number at the bottom of a report. I mean the real moving parts, right? The divisions that are absolutely crushing it, the ones that are steady earners, and yeah, the ones that really need your focus. Getting that level of clarity, that's your job number one.
Okay, so here's our game plan for this briefing. First, we're going to talk about why that single aggregated view is a problem. Then, we'll look at how your lens, the management approach, fixes that. We'll get into the nitty-gritty of identifying your operating segments, talk about why this is so valuable strategically, and wrap up with the tricky balancing act of disclosure. Pretty straightforward.
All right, so first up, beyond the aggregated view. We're talking about the problem with that blurry picture I mentioned. The standard consolidated financial statement, well, it often hides a lot more than it actually shows.
I mean, think about it like this. Let's say you've got a super high-growth tech division and, on the other hand, a stable, maybe legacy manufacturing arm. When you just mash those results together in one consolidated statement, you just get an average. It's a blend. And that number totally smooths out the peaks and valleys, which means you lose all that specific, actionable info. And let's be honest, you just can't make sharp strategic calls when you're looking at a blurry picture.
So, how do we get some focus? Well, the solution is built on this really core principle called the management approach. It sounds technical, but the idea is actually super simple and powerful. We're going to see the business through your eyes.
And look, this isn't just some nice-to-have suggestion. It's literally the whole point behind modern segment reporting. The standard board itself says the goal is to allow people to review the operations through the eyes of management. And what that really means is you're turning what could be a boring compliance task into an incredibly powerful communication tool.
And here's the absolute key takeaway. This whole process starts with you. Seriously. The way you already run the business, how you set up your management meetings, the reports you demand, the parts of the company you review to decide where to put money and people, that internal rhythm is exactly what determines what gets reported as a segment. Your focus literally defines the entire framework.
Okay, let's get down to brass tacks. How do we actually translate that internal view of yours into official reportable operating segments? Well, it's not random. There's a formal three-point check, and every single potential segment has to pass it.
So here's the official definition right from the accounting standard, AASB 8. It says an operating segment is a component that does three things. And what's really important to get here is that it's not about what a department is called. It's all about what it does and, crucially, how it's managed.
Let's break that down into three simple checks. First, it has to be involved in actual business activities. It's got to be earning revenues and spending money. Simple enough. Second, and this is the big one, you, the CIDM, have to be regularly reviewing its results. We're not talking about a quick look once a year. This has to be part of your routine for checking performance and deciding where resources go. And third, there has to be separate or discrete financial info available for it. Think of it like a dedicated P&L statement just for that unit. And remember, it's not 2 out of 3. It has to be a yes to all 3.
So this naturally leads to the next question. What is not an operating segment? Because this is a really important clarification. Just because a part of the company is vital doesn't automatically mean it qualifies under this definition.
Yeah, so think about your corporate headquarters, or essential departments like HR and legal. They're obviously essential, but they usually don't generate their own revenue, right? They're cost centers, so they're not operating segments. The same thing goes for stuff like post-employment benefit plans. They are critical functions, for sure, but they aren't the business units you're evaluating for their commercial performance.
Okay, so now that we know the how, let's talk about the why. This is where we move from just a compliance headache to a genuine competitive edge. Why go through all this trouble? Because what you end up with is an incredibly powerful analytical tool, not just for you, but for your investors too.
And here is the strategic goal. With good segment data, you get a much clearer shot at predicting future profitability because you can actually see the real growth engines. You can properly assess how your different teams are doing, whether they're in different industries or all over the world. You can spot and isolate risks that might be hiding in one part of the business. And maybe most importantly, it creates crystal clear accountability for the leaders of each of those segments.
But of course, all this transparency comes with a pretty big strategic challenge.
And this is a big part of your job as CODM. You have to walk a very fine line, managing this delicate balance between giving helpful insight and creating a whole lot of competitive exposure.
Okay, on one side, the insight you're providing is invaluable. It shows everyone the true performance drivers of the organization. But on the other side of that scale, you have exposure. Your competitors can now see exactly how profitable your best divisions are. What do you think that does? It practically paints a target on them, maybe encouraging new players to jump into your most profitable markets. And it can also put a bright spotlight on any underperforming segments, which might just attract an unwanted takeover bid. This is that critical strategic tightrope you'll be walking every day.
And that brings us right back to where we started. At the end of the day, segment reporting isn't just some accounting rule you have to follow. It's a tool. It's a way to see your business with total clarity, the same way you see it. The whole process is a mirror, reflecting your focus and your priorities. And with that kind of power comes a whole lot of strategic responsibility. So the real question is, now that you can see the whole unvarnished picture, where are you going to focus first?
Have you ever wondered how these massive corporations really operate behind the scenes? Well, there's a kind of secret language hidden in their financial reports, one that reveals all these cozy deals and hidden connections. Today, we're going to decode a huge part of that language: related party disclosures. Let's dive in. Look, we all do business with people we know, right? You might hire a friend's company, maybe loan some money to a family member. It's totally normal. But when a giant, publicly traded company does the exact same thing, the stakes get a whole lot higher. And that really gets to the heart of the matter, doesn't it? We know just intuitively that the answer is no. A deal with someone you have a connection with, well, it's not always on a level playing field. And that's the exact conflict of interest that financial regulators are trying to get a handle on. So to really understand the risks here, we've got to get the language right. You see, the world of accounting has some very specific definitions for who actually counts as family in the corporate sense. Let's break down who's who. Okay, so this is the crucial part, and it comes from a big accounting standard, AASB 124. A related party transaction is basically any transfer between connected people or companies. Now, pay super close attention to that last part, regardless of whether a price is charged. That means even just giving something away for free still counts. And this diagram here shows you just how messy these relationships can get. You've got a parent company that might be shifting inventory over to one subsidiary, giving a loan to another, and paying out big bonuses to its top managers. It's this whole web of transactions all happening inside the same corporate family. You know, the rules make a really key distinction here. Think of it this way. Control means you're actually driving the car. You're setting the direction. Significant influence means you're the passenger who has the map and a very, very strong opinion. You can't actually grab the steering wheel, but you for sure have a say in where that car is going. Both of these situations create a related party relationship. And here's how that can build up. So company C isn't directly controlled by A or B, but both of them have significant influence. They each have a voice at the table. This just shows how one company can be tied to a bunch of others, creating that complicated web we were just talking about. All right, so these deals are happening all the time. But why is it such a big deal? Well, because when these transactions happen in the shadows, they can be a massive risk to investors, to employees, really to the market as a whole. So here are the core dangers. These deals often aren't done at arm's length. That's a fancy term that just means they weren't negotiated like they would be between two total strangers in a fair market. Prices can be puffed up or pushed down to move profits around, to pay less tax, or even to commit fraud and make a company look way healthier than it actually is. And believe me, this isn't just theory. This quote really hits the nail on the head. Time after time, when you look at major corporate collapses, you find a history of sketchy related party deals in their past. These regulations were basically born from the ashes of those very scandals. So what's the solution? Do we just ban companies from doing business with anyone they have a connection with? Not exactly. The answer that regulators came up with is actually much simpler, and you could argue way more powerful: transparency. The whole philosophy is this: fine, let the deals happen, but don't let them happen in secret. By forcing companies to disclose every detail of these transactions, you're empowering investors and the public to look at them and decide for themselves if something seems off. And these disclosure rules are super specific. Companies have to name their parent company, they have to describe the nature of the relationship, state the exact dollar amount of the deals, and list any money that's still owed. Basically, there's nowhere to hide the important details. Okay, let's zoom in on one of the most watched areas of disclosure, how much the top executives are getting paid. Because when you think about it, a CEO's salary is by definition a related party transaction. You know, an executive's pay isn't just a simple salary. It's this complex package of short-term cash, long-term bonuses, retirement benefits, stock options, the whole shebang. These disclosure rules force companies to break it all down so that everyone can see the complete picture. In Australia, for instance, the Corporations Act actually requires this thing called a remuneration report. It's a whole dedicated section of the annual report where the company has to lay out and justify its pay policies and show how they're connected to performance. And this brings us to a critical number, 25%. If 25% or more of a company's shareholders vote no on that pay report, it triggers what's called a first strike. It's like a powerful warning shot from the investors fired directly at the board. And it doesn't just stop there. This is what's known as the two strikes rule. So you get a first strike, and the board is on notice. If they get another 25% no vote the very next year, that's strike two. And then shareholders get to vote on whether to spill the board, which could force all the directors to stand for re-election. It gives shareholders some real teeth. So after all these definitions and rules and regulations, what's the big takeaway? Why does any of this matter to you or me if we're not an accountant? Well, it all comes down to trust. At the end of the day, these disclosure rules are here to make sure that everyone, from a giant investment fund all the way down to the smallest individual shareholder, has the information they need to judge a company's real performance and its integrity. It's really a cornerstone of what keeps our markets fair. Which kind of leaves us with one final thought. We've worked to bring all these related party deals out into the sunlight, but in our incredibly complex global economy, you just have to wonder, what other deals might still be hiding in the shadows?